Okay, so welcome back. We were talking about the crazy weather we've had the past few days. I don't know about you guys, but it makes it a little bit more difficult to get out of bed in the morning with the, I guess we call it fall weather. It's important that we continue pushing to that finish line. And even though sometimes it's easier to stay in bed, I hope that you guys are either coming to class or watching those recorded lectures. So we have a packed agenda. Chapter 18 has a lot in it. So the chapter is entitled Cost, Volume, Profit, or at least it should be. I think it's called Cost Behavior and Cost Estimation. But it's all about three initials: cost, volume, and profit, and how they are interrelated, and how if we study how costs behave, then we'll be able to do a lot more forecasting properly. And that's why this chapter is foundational for the rest of the class. So we're going to start off by talking about cost behavior. The good news is if you've had an econ class, an economics class, you will have been exposed to some of these. You will have graphed some of these, and you would have some experience with calculating slopes and so forth. In today's class, we're going to talk about the difference between variable costs, fixed costs, and the all too dangerous mixed costs. And mixed costs are dangerous because they don't allow us to forecast properly. And so we'll talk about, I'm going to show you a PowerPoint later. We'll talk about the danger of mixed costs and projections and how we can't have them. They're no-nos. And so we're going to talk about ways to take those mixed costs and to split them into the two components, variable and fixed. That'll be one of the first things we talk about today. So someplace in your notes, we can't have mixed costs when we forecast. And so we have to have some type of a way to split the two components out. And there are three major ways to do that. In this class, you guys are only responsible for one. You're responsible for the high-low method. I'm going to demonstrate that to you. But there's also scattergrams and the least squares regression method, which is calculus-based. I'm glad you guys are not responsible for that because I have nightmares still to this day about calculus. And then we'll focus on the contribution margin, and that's probably the most important thing we're going to talk about after how costs behave, is what is this thing called the contribution margin? What is it, and how are we going to use it in this class? And every single time I get the opportunity to do this, even if the book doesn't ask us to, I'm going to express it in three ways. I'm going to express it in dollars and in units, and then also as a ratio, which we're going to call a contribution margin ratio. So I would encourage you guys, as you're working on your homework, even if a problem only asks you, let's say, for a contribution margin in units, let's say, if you can, go to the extra length to calculate those contribution margins three different ways: in dollars, in units, and as a percentage. They're going to give us a lot of insight into projections. We're going to learn today that our income statement, we've been using pretty much GAAP income statement since the first day of class. We're going to change the format because this contribution margin income statement is going to allow us to do a lot of what ifs and forecasting. And so we're going to learn a different way of looking at income statements. And then a spin-off of the contribution margin concept is the ability to calculate a break-even point. Okay, how important is a break-even point? If you want to start up a business, the bank, unless you have rich parents, the bank or whoever you're going to be getting your funding from is going to ask you for a business plan. And one of the key components within that business plan is how much do you need to sell to break even? So this is going to become critically important to any potential entrepreneurs out there. We're going to talk about what does it mean? What's a break-even point? How do we find it? And then again, every single time we're asked to do this, I'm going to do it in units and in dollars. And we know that we live in a capitalistic society. And so in our society, we're not just looking to break even, right? There's not too many business owners that would be out there doing what they do if all they expected to do was to have zero net income, to break even. And so we'll tweak that formula a little bit And we'll talk about target profit points, right? I'm not happy as an entrepreneur just breaking even, unless it's pandemic days and you're just fighting for survival. But in normal times, we want to generate a profit. And so we'll talk about that target profit point as well. So lots to cover. Again, I put this in there to keep me organized, but more importantly, I think to give you guys a checkoff list for the test. Can you go through that agenda and can you answer what each of those line items are and how you would calculate it? Questions on that? All right, let's bring this PowerPoint up because I like the way that it graphically identifies some of these things. You guys have the full PowerPoint within the modules link. I'm not looking at the full PowerPoint. I'm using some of the graphs that the author has created. So this whole chapter is how do costs behave and how is cost, volume, and profit, how are they related to each other? And so CVP, you might hear me say that, CVP is the topic of this chapter. So here's some of the questions that cost, volume, profit is going to allow us to answer after we talk about the chapter. How many units do we need to sell to break even? Okay, part of every single business plan. How many units do we need to sell to break even? And then there's always what if scenarios that come into play. What would happen to my net income if I brought in a machine or a robot or some technology? What would happen if I installed this big machine and paid $1 million to it, but I could reduce my labor costs? What happens to my net income? A big one that I just finished helping a company with, should we expand our production to Mexico? And what's going to happen with our net income if we do that? What is the change going to be in income if selling prices go down, right? So we decide to lower the price and the volume goes up. What's that going to look like on our bottom line? And what if we change the sales mix of our products? Something Best Buy and Best Buy is the one I've been reading about, is really experimenting with, moving more from selling electronics to doing home-based technology and things like the Ring doorbell and being able to turn your heater on via your phone, turning lights on and off from your phone. So what if we're going from product-based to more service-based? What happens to our net income? And then also along the break-even lines, we're going to tweak it a little bit. If we're not happy with breaking even, then what type of volume do we need to make our shareholders happy, right? If our shareholders are expecting us to make $1 million on the bottom line, what kind of volume is it going to take for us to get there? So all these questions can be answered with the cost, volume, profit chapter. Part of your upper level finance classes that if you're a business major, you will be taking, will dive deeper into this. There are some complicating factors that come into play like taxes and some other things. So this is really a 20,000 foot level, an overview of cost, volume, profit. You'll dive deeper into some of the complications in your finance classes that you'll take at the university. Questions on that opening slide, because I think that's a great slide about all the different things that this chapter is going to teach us. Okay, then let's talk about cost behavior, because if we don't understand how costs behave, we will not be able to forecast and do these predictions coming up in future chapters. Let me make this bigger here. So fixed costs, most of us know from our econ classes, a fixed cost is a cost that remains static even though activity levels change. And an example of that, here I go in the morning again, I'm hungry. If we think of a pizza place, right? Papa John's, let's say. Their rent is fixed. It doesn't matter if they make 500 pizzas or 10,000 pizzas. The rent that they pay down the street from me is a fixed line. So here on the chart, it's that orange line. How do I know it's that orange line? Even though we've made 0 units, it's still 30,000. I think it's close to 30,000. And if I came out here to 1,800 units, it still looks like it's 32,000. That fixed cost doesn't change as the activity level change. Well, why is that important to forecasting? Because when we look at different levels of selling a product, the fixed cost will remain flat. Now, most students have no trouble understanding that flat line. Fixed costs in total remain fixed. The problem is, what if you ask a student, what happens to fixed costs on a per unit basis? That's where they have the problem. Okay, so we're going to talk about that for a second because I remember this throwing students off. On total level, on a total cost level, the fixed costs remain flat. However, if I asked you what happened on a per unit level to fixed costs, you need to be able to think about it. And what you should tell me is that as the number of units go up, the fixed cost per unit actually go down. That's called, in mathematics, that's called an inverse relationship. So let me give you an example to explain that. Let's assume that we're going to have a party in class. I wish we could. I wish we were in a position where we could have some kind of a party together. But let's say we have a party, and let's say the entertainment costs $100, right? I'm going to pay someone to come in and talk to you, and it's going to be $100. If 20 of you come to my party, that turns out to be $5 a student. 100 divided by 20 is 5. If 40 of you come to my party, it's going to be even less. It's going to be $2.50 a unit. If one of you comes to my party, it's going to be $100 a unit. So do you see that on a per unit level, the more people that come to my party, the more that fixed cost is spread out, and it has that inverse relationship. As the number of people that come to my party goes up, the fixed cost, the cost I'm spreading out to all the units, goes down. You need to write that down. That has an inverse relationship. And you see an example of that right there. I don't know if they use that word. They use it in your book. Let me write it down in case you're looking for it. Inverse. So on a per unit level, as the activity increases, the per unit cost decreases on fixed costs. That's why, by the way, and then I'll take questions. That's why Costco can usually sell things much cheaper than other places. Okay, why? They have fixed costs. Those warehouses are huge, but they sell so much in volume, and they only sell specific types of things. If you want to go buy toilet paper, there might be 2 brands, their brand and Charmin or something. But all those fixed costs are spread over so many people that they can usually drop their sales price to a lower degree than somebody that doesn't do the volume that they do. Questions on that? Okay, then the opposite of a fixed cost is let me get the title up there, a variable cost. Okay, a variable cost is a cost that increases or decreases in proportion. I'm going to write that down. In proportion to changes in activity levels. Okay, in other words, again, back to the pizza example, if I sell 0 pizzas, then I need 0 pepperoni. If I sell 2 pizzas, I don't know how many pieces of pepperoni are on a pizza, let's say 20, then I need 40 pieces of pepperoni. If I sell 5 pizzas, I need 100 pieces of pepperoni. That's a directly proportional relationship. So variable costs start at 0, here's this orange line here, and they go up in a proportional, what you learned as a proportional slope if you took an economics class. Okay, however, and again, most people get that. On a per unit basis, right back to that pepperoni, on a per unit basis, the per unit cost of the pepperoni stays flat. If there's economies of scale, and eventually I know if Papa John's made enough pizza, they might be able to get a little bit cheaper. I get that. We're talking about in general terms. So variable costs change in direct proportion to changes in activity levels, But on a per unit basis, those variable costs, there's that orange line, remain flat. Questions on that? Because if we don't understand how these costs behave, we won't be able to do these predictions. All right, here's the danger zone. Get up. Mixed costs are dangerous. We can't have them. Mixed costs are costs that have a portion of fixed costs and a portion of variable costs built in. Okay, I remember going to Europe a couple summers ago before the pandemic. And when I came home, I'm thinking, oh, my electric bill is going to be so low, I won't know what to do. Okay, well, that didn't happen. It was lower, but because there's so many fixed costs built into an electric bill, the bill was still pretty high. So electricity is an example of a mixed cost. Even though I wasn't home and wasn't using electricity, there's a component of that cost that is fixed. The rest of it is variable. And that's the ones that we can't have. So in your notes, mixed costs are dangerous for forecasting. And so we're going to learn 3 ways to get rid of them. Our focus is going to be on the high-low method. When you look at a total cost line, which is the green one here, in case you can't see that, let me just kind of put a squiggly line through it. It's the green line on my screen. That is total costs. A portion of those costs are fixed. How much? The part that at 0 still has a cost here. The fixed costs here are $32,000. That was the rent. So the way that you would measure variable costs is the difference between those 2 lines, between the fixed cost line and the total cost line. That's how you measure variable costs. We're going to be using a mathematical approach called the high-low method, but you could also use a graphical approach. The book will talk about a scattergram. If we were in a classroom, we'd talk about graphing. I'd bring in graphing paper for all of you, and we would graph and chart scattergrams. But in an online environment, it's just too difficult. So know what a scattergram is, but we won't have you charting anything. So we have fixed costs, which on a total level remain fixed, even though the activity changes. We have variable costs on a total level that change in direct proportion to changes in activity level. And then we have these oddball mixed costs, which has components of both in it. We can't have mixed costs. So we're going to, in a minute, talk about ways to find out which portion is fixed and which portion is variable. Lots of information in there. Any questions?
No, I found it funny because I was doing the same thing. I was trying to now separate expenses, and I bumped into like, where do I put my electric? Because it fluctuates, but not by a much, just by a little. But there's a fluctuance in the electric, even on the phone bill, because it keeps steady, but there's a fluctuation.
Yep, those are good examples of mixed costs. And the reason it fluctuates is because part of that is based on usage, but there's a big chunk that's also fixed.
Mm-hmm.
Good example. Stepwise costs. If you look at them graphed, it's like a stair-step approach. Think of this as if you have, for example, if you produce so many units, it's one cost for a supervisor. But as soon as you need more people, even to do a second shift, all of a sudden it jumps up, or you need a second supervisor once there's more people on board. So stair step, they remain flat over a particular range, but then eventually you get to the point where you need another supervisor or another shift of people. That's a stepwise cost. And I do remember there being a couple multiple choice questions on cost behavior from a graphical perspective. So we're spending a little bit of time going over this, but the book does a very good job on the graphs and explaining it. And then curvilinear costs are costs that increase, but in a non-linear manner. And there's usually because some efficiencies of scale are in there. We won't deal too much with those in this class. So how are we going to measure cost behavior? We know that the mixed costs got to go. The mixed costs are going to cause us headaches in our cost projections. And so, as I mentioned, there's 3 methods for splitting out the costs behavior. And Danya, you could actually do this on your phone bill to test it out. There are 3. There is a scattergram, which is a graphical approach where you plot units and dollars, and you'll see a series of dots all over the graph. The goal is to try and draw a line through as many of the midpoint of the dots as you can. We're not going to worry about that. We're going to use probably the easiest and a mathematical based approach, which is called the high-low method. I think our first homework problem's on that. So rather than give you a bunch of notes on how to do the high-low method, we're going to just jump in and try one, and we'll go through the steps as we go. And then the most accurate, but also the most difficult, is that calculus-based linear regression method that, again, you should know the name of, but we will not be doing it in here. You will be doing it in your upper level finance classes, where the instructor will require that you have a special kind of graphing calculator as well. So here's an example of that scattergram where all they did is they plotted these green points, and they took historical data and they had data with how many units versus the cost, and they plotted these green points, and then they tried to draw a line between as many of those points as possible. And that's called a scatter diagram. What we're going to do is jump into this high-low method. So I think this is a good place for me to probably leave the PowerPoint and just jump in and demonstrate to you how to do the high-low method. We may come back to this PowerPoint when we talk about the contribution margin, but for right now, I think we're at a good point where we can go get our hands dirty and jump in and show you how to do the high-low method. So any questions before I leave the PowerPoint temporarily? Okay, hopefully you guys have downloaded the Excel files by now.
So our first exercise is going to ask you to classify each of the following costs as either variable, fixed, or mixed. This set of costs has to do with a manufacturer of portable basketball hoops. Take a minute, jot your answer down, and we'll compare answers in a few minutes. Check out the answers and see if you were able to get them all correct. Again, our future projections will depend on how well you master these basic concepts. Because we know mixed costs are dangerous, this exercise will give us some practice at taking some grouped mixed costs and splitting them out between their variable and fixed components. Let's read the question together, talk about the strategy for solving, and then we'll give you a shot at trying it. It says Felix and Company reports the following information. They want us to use the high-low method to estimate the fixed and variable components of the total costs, and then they want us to use that information to estimate the total costs if 3,000 units are produced. So it looks like they give us 10 periods worth of information. So I wrote down the steps to get them into your notes on how we will attack mixed costs, because mixed costs cause us problems. Step 1 will identify the high and low points. So looking at the chart given, find the highest point in terms of total cost and the lowest point in terms of total cost, and identify those 2 periods. Isolating just those 2 periods, step 2 will compute the change in the total cost. Take the difference between the high and the low point in terms of total cost. Step 3, using the same 2 points, compute the change in total units. Step 4, divide those 2 items. Take the change in total cost divided by the change in total units and that will give us the variable cost per unit. How do I know that? Remember that fixed costs don't change over the relevant range of activity, so any change therefore must be due to the variable costs. And then use that information to plug the numbers into the total cost formula. So step 5 says use the total cost formula to plug or to back into the fixed costs. And once we know how much of that cost structure is variable and how much is fixed, we can use that information to do a projection. In this case, requirement 2 asks us to do a projection if 3,000 units are made. Pause the video, walk yourself through those steps, and then let's compare answers. Let's see how you did. The highest point in terms of total cost was period 10, and the lowest point was period 1. So the costs for the high point was $7,900, and the costs at the low point were $2,500. We took the difference between those two to come up with the change in total cost. Next step, we took the change in total units, and we came up with 3,600 units. We divided the two to come up with a key figure, the variable cost per unit. And then we can choose either of the 2 points, either the high period or the low period, to use the total cost formula to plug or to back into the fixed costs. The total cost formula is that total cost equals the sum of variable costs and fixed costs. I chose the high point, but you could also choose the low point. At the high point, the total costs were $7,900, and based on a variable per unit cost of $1.50 multiplied by the 3,600 units that were created at the high point, you can do the math. And once we solve for fixed costs, we came up with 2,500. We'll work on that prediction on requirement 2 in a moment. With the data that we acquired in the above exercise, we know now that variable cost is $1.50 a unit and fixed cost is $2,500. The author asks us to make a projection based on 3,000 units. So we multiplied the 3,000 times $1.50 per unit, and then added 2,500 to cover the fixed costs. At any point over the relevant range, now we are able to make a prediction because we have an understanding of how the costs behave. Let's see if you came up with the 7,000 in total cost that I came up with. Let's try another. I gave you another one for extra practice. In this problem, they give us 12 months worth of data. And if we scroll to the bottom, they want us to do the same thing. They want us to estimate the variable cost per unit, as well as the monthly fixed cost using the high-low method. And then they asked us to do 2 projections on what the total cost would be based on the data that we acquire. So my question for you is, can you write down the steps? Think about it, pause the video, and let's see if you can correctly write down the steps involved. Here they are. Step 1, identify the high and low points. Take your pencil or a highlighter and choose the 2 points that we'll do the computations on. Step 2, calculate the change in total costs. Then calculate the change in total units. Divide the 2 to get the variable cost per unit, and then plug for the fixed costs. Use that information that you gather to do the 2 predictions that the author requested. I'll pause the video and be back with the answer. Let's check your work. We identified the high point and low point. We calculated the change in total costs, where we came up with 52,000. We computed the change in total units, which was 130,000. We took those two and divided the change in costs by the change in units, and we came up with 40 cents as the variable cost per unit. We then used either one, either the high or low point, to plug or back into the fixed cost. This came out to be 24,000. And then based on that data that we gathered, we did two projections, one at a volume of 100,000 and one at a volume of 170,000. This should help assess on whether you have a good understanding of what to do with mixed costs. Let's move on to our next topic.
I'm going to go back to this PowerPoint then, because I remember seeing some good slides on this next concept, which is called the contribution margin. This is going to drive our remaining income statements going forward from this chapter on. Here's what we're used to seeing. I'm going to put a traditional income statement up here just to remind us what one looks like. I know you guys don't need reminding because you're accounting 102 students, but sales less cost of goods sold gives us gross profit. We took out our operating expenses and we got net income. Okay, that's a traditional income statement. It's what we've been studying for 3 semesters now. Okay, our income statements are about to change because we're interested in making internal decisions and forecasting. And should we do this or should we do that? Should we increase our sales price? Should we decrease our sales price? We have to have a way to forecast. And the problem with this traditional income statement is that the cost behavior is not there. Part of cost of goods sold is variable, part of it's fixed. Part of the operating expenses might be variable, part of them are fixed. So we're now going to turn to a contribution margin approach. And a contribution margin is equal to the selling price minus the variable costs. Okay, and that's what that slide shows you. We're going to calculate the contribution margin 3 ways. And so I want you to get these 3 ways down into your notes, because even if the author doesn't tell us to do it, we're going to calculate it 3 ways for extra practice. The 3 ways we're going to calculate. Oh, go ahead, Danya, question?
Just so I can try to understand it before you.
Yeah.
So in other words, selling price unit, I'm just saying it's like my sales, and the variable cost is my cost of goods sold. If I kind of wanted to match it up.
Not necessarily all of the cost of goods sold, right? Remember what's in that. The rent for the factory's in there someplace. So not all of the cost of goods sold, just the variable cost components. So it would be the direct materials is always variable, and the labor is always variable. By definition, it's a direct cost. And then any other variable cost, it could be sales commission is a variable cost. It's not part of cost of goods sold, but it is a variable cost. That's why we're going to change the way we think now about these items.
Okay.
So all the variable costs associated with the unit that you're making, whether they're factory costs, whether they're selling costs, all the variable costs of selling that is our contribution margin. And I'm going to explain a little bit more what that contribution margin means in a minute, but let me get the 3 ways down that we're going to show it. We're going to show it in dollars. We're going to show it per unit. And we're going to show it as a percentage. And that's called the contribution margin ratio. So throughout this chapter, you're going to see me keep emphasizing that. And I think back to Danya's question, because it was a really good one. The contribution margin is what's left after you pay for all the variable costs. And so our traditional income statement is going to kind of take a back seat now to what we call this contribution margin income statement. And this is what it's going to look like. We're going to take sales less variable cost. I'm sure this is coming up on the slide. And that's going to give us this contribution margin. So I want to talk a little bit more about what that contribution margin means. It's how much you have left to cover the fixed costs and to generate a profit. Okay, in fact, I'm going to write that down because that's pretty important. Let me go back here. So we have sales, and we take out the variable costs, and we have this contribution margin. And what that contribution margin represents is how much is available to cover fixed costs and generate a profit. Now, whether it's in total dollars, whether it's on a per unit basis, it's how much you have available to cover the fixed costs and generate a profit. Here's the thing that I don't think the book quite captures the importance of. Once the fixed costs are covered, in other words, once you have sold enough to cover the variable and fixed costs, every single additional dollar goes right to profit. So once you hit your fixed costs, once you've covered all those, then every additional dollar goes down to the bottom line. Every additional sales dollar goes to the bottom line. And when I say bottom line, I mean net income. I'm sorry that's so messy. I'm writing sideways. I'm sure Eddie's notes will be much neater. So what is a contribution margin? The contribution margin is how much is available to cover fixed costs and generate a profit. So once you have your fixed costs covered, okay, in other words, once your fixed costs have been paid off, then every additional sales dollar goes right to the bottom line. Now, if that seems confusing, I promise you that as we work out these problems, you'll have an idea of what I'm talking about. Questions on that? One of the reasons that the contribution margin is so important is because it's going to come up in the break-even point. And we're going to go jump in and do a couple of exercises so I can emphasize the importance of knowing what your contribution margin is. But I do want you guys to note that there are, once I get rid of this Word document, there are some very good slides in here on the break-even point. So you might be saying, well, how in the heck do we get from the contribution margin to the break-even point? The contribution margin is going to be used in finding the break-even point. Okay, so I think it would be in our best interest right now to go jump in and look at what the contribution margin tells us. I'm going to expand a little bit on why the contribution margin is important as we work through these problems. This is how decisions are made on whether to automate or not, whether to do layoffs or not. So many of the decisions that we make at a management level goes back to the concept of this contribution margin. So
let's start off with the basic math concepts behind the contribution margin. In this exercise, they gave us some of the data, but not all of the data. Pause the video and see if you can calculate the unknowns in letters A through F. We'll come back and compare answers. To visually simplify what's going on, you'll notice that I put the unknowns in different colors. I use yellow for company A and peach for company B. Take a moment and see if your answers match up. The first thing I solved for was the units sold. Since I know that sales were 208,000 and I knew that the per unit cost or sales price was 65, I simply divided to get the 3,200 units sold. Once I knew how many units were sold, I could take the variable cost and divide by those units sold to get the variable cost per unit of 47. Then I could do simple subtraction on the contribution margin line item. And finally, because I was able to calculate the contribution margin and I knew what net income was, I could take the difference to compute the fixed costs. Using a similar type of logic, I also computed company B. Take a look at the answers, and if there's anything that you missed or anything you struggle with, make sure you reach out for help. The break-even point, or break-even sales, is the sales level at which total sales equal total costs. This means there is no net income and no net loss. The break-even point can be stated in either units or dollars of sales. Usually, we'll practice computing them both ways. There are 3 different methods that we will be looking at to find the break-even point. Most of the time, we'll look at the formula method since it's very easy and straightforward. But it's also possible to back into break-even sales using a contribution margin income statement, or for those of you that are more visually oriented, a cost volume profit chart. The formula method will be a simple formula that we will use to compute the break-even point in units. Fixed costs go on the top, and the contribution margin per unit goes on the bottom. When you divide the two, you'll come out with the break-even point in units. If, on the other hand, you want to compute the break-even point in dollars, you can either take the break-even point in units times the selling price, or you can use the second formula you see on the screen, which is fixed costs divided by the contribution margin ratio. I'll be demonstrating both of them to you shortly. In this example, a company manufactures a single product that sells for $180 per unit, whose variable costs are $135, and whose fixed costs are $562,500. The author asks us to compute 4 things: the contribution margin per unit, the contribution margin ratio, the break-even point in units, and the break-even point in dollars. Let's take a stab at it. The contribution margin per unit is the difference between the selling price and the variable costs. In this case, that comes out to $45 per unit. So that's our answer for letter A. Letter B wants us to turn it into the contribution margin ratio. This is the contribution margin per unit divided by the sales price per unit. In this example, we would take the 180. The contribution margin ratio is the contribution margin per unit divided by the sales price. When we perform that calculation, we will get a contribution margin ratio equal to 25%. I would encourage you to get in the habit of carrying that out to at least 1 decimal place. That means that for every sales dollar, there's 25% available to cover the fixed cost and generate a profit. Next, we'll take a look at the break-even point in units. That break-even formula is fixed cost divided by unit contribution margin. Okay, I'll write that out because this may be the first time you've seen me abbreviate it. Fixed cost divided by the unit contribution margin. In this case, the fixed cost was given to us at $562,500, and the break-even per unit, the contribution margin per unit was $45 from the first requirement. And when we pop that into our calculators, I'll go ahead and let Excel do the calculation. This will give us our break-even point in units. So I'm going to write the word units. That means at a sales level of 12,500 units, there would be no net income and no loss. That's the point where the revenues equal the costs, and we are said to have broke even. To To turn that into dollars, a shortcut way to do that would be to take the 12,500 units that we just computed and multiply it by the sales price. The sales price in this one was given at $180. So to turn those units into dollars, I'll let Excel do the math. And when I multiply those two out, I got 2,250,000 sales dollars. At that level of sales, the company would break even. Or you can use the author's formula, which says take the fixed costs and divide by the contribution margin ratio. So I'll demonstrate that the two answers will be the same by taking those fixed costs and dividing by the contribution margin ratio from letter B. And when we carry out the arithmetic, let me put a divider line in there. When we carry that out, we should come up with exactly the same answer we got using that shortcut method. And as you'll see, these two numbers are equivalent. That's our first attempt at an easy break-even point. Let's keep it up and let's continue on. We could also approach the same problem from a contribution margin perspective. So once again, the author tells us that the facts are the same as they were in the previous exercise, except this time they want us to compute the break-even point based on a contribution margin income statement. So in the interest of time, I created that income statement on my Excel worksheet, and I'm going to work backwards. I know that at the break-even point, my net income is 0. Since my fixed costs are $562,500 and my net income is 0, that means my contribution margin at the break-even point is equal to the fixed cost. That's what makes that result of 0 work. Going from here, I can take a look at the percentages that each one of these line items make up. Sales is always 100%. The variable costs, if I take the variable costs and divide by the sales percent or sales price, would give me a variable cost percentage of 75%. And as we already know from the previous problem, our contribution margin percent would just be the difference. Using that information, we can work backwards based on the data that we have. We know if our contribution margin is 25%, we know that sales minus the variable cost is $562,500. Another way, if you want to write a formula for that, the contribution margin is equal to 25% of X. And if X is the sales, the way we would calculate that once I put in my contribution margin, let me put this in a formula so you can see it. For a lot of you that have had algebra and so forth, to get X by itself, I would divide both sides by 0.25. And what I'm left with at that point is a formula for sales that I can easily calculate. So let me go ahead and do that. Sales at that point would have to be 2,250,000, which, by the way, matches the answer we got in the previous problem. And since that's 100%, and we know that variable costs are 75%, a way that I could get my variable costs would be simply to take the sales times 75%. That method sometimes throws people off, so I would encourage you to calculate that on your own in case that is given to you in the form of a multiple choice question or a quiz question or something of that nature. And then number 2 will have you do the same process again, but in this case, they're going to increase the fixed costs. So you would go through the same problem with the increased fixed costs. Take a moment to do that and we'll compare answers. The answer to the second part is 2,790,000. Once again, work from the bottom up. This is 0. We increased our fixed costs by 135,000. These two are equal. To come up with that sales, we took that contribution margin divided by 25% to come up with the sales number. And to fill in that final blank on the variable cost, if you wanted to fill that in, you would take 75%. Again, these tend to trip students up a little bit, so work a few out prior to exam time. 1811 is the same type of break-even problem, so by now you should start feeling comfortable with the calculation. Here's the answer to check your work. There are many applications of cost, volume, profit concepts. On the screen, you'll see a cost, volume, profit chart. Although we won't have time to go over exercises such as this in class, make sure you have the ability to read one. You'll notice that the green line is the sales line, and the red line is the total cost line, since break even is the intersection of these two lines, or the point where no income and no loss is made. Notice that you can find the break-even point by looking at the intersections of the line. In this case, it looks like it's 800 units or $80,000. So take some time to go over the book. You can also measure the profit and the loss by comparing the green line to the red line and subtracting the two. As we know, in a capitalistic economy, not too many companies are happy with breaking even. So another offshoot of the break-even formula is computing sales for a target income, or what I prefer to call a target profit. If you look at the formula on the screen, you'll notice that the break-even point has been tweaked. In the numerator now, in addition to fixed cost, you'll see the number target income. That is the amount of net income pre-tax that a company is desiring to generate based on a lot of different factors. In this class, the targeted income number will be given to you. In real practice, it takes a lot of projections to come up with that amount and what it should be. So once again, this is a tweak on the break-even formula. Check out the numerator and you'll notice that target income has been added. If we're trying to compute this in units, then you'll notice that we're using the unit contribution margin on the bottom. To turn that into dollars, into target profit dollars, we would follow the same steps we followed with the break-even point. The shortcut is to take the units and multiply by the selling price, or you can just use the revised formula, which replaces the unit contribution margin with the contribution margin ratio. Let's try one out. In this exercise, as with most companies, they're not happy in breaking even. They want to generate a target income of $162,000. And so requirement 1 asks you what amount of sales dollars, okay, that's key. It'll tell us what to use on the bottom. What amount of sales dollars is needed to produce this target income? So we're going to do a target profit point. And because the author asked for it in dollars, we'll go ahead and label it in dollars. The formula is to take the fixed costs plus the desired target profit. And because the amount was asked in sales dollars, we'll put the contribution margin ratio on the bottom. We'll get this information based on the previous exercise that was very similar. We'll start off with the fixed cost given as $324,000. We'll add in the $162,000 given to us in the problem, and we'll divide by the contribution margin ratio of 20%. When we pop that into our calculator, we will have the target profit dollars needed to generate the desired profit, $2,430,000. Take a look at that, see if you have any questions. It's just one more application that comes out of cost volume profit and specifically is an add-on to the break-even point. Let's take a look at number 2, which asks us for the margin of safety. Let's talk about that concept before we compute it. When I think of the margin of safety, I think about a cushion or safety net. Of course, all companies want to do better than just break even. So a company's margin of safety shows how far above the break-even point a company is. Again, in my head, I think of a cushion. So look at the formula. It is the expected sales that you'll generate less the break-even sales. There's your cushion. And it can be expressed in dollars, which is what that numerator would give you, or you can turn it into a percentage, or what your author calls the margin of safety percentage. How do you turn that from dollars into a percentage? You add the denominator, which once again is the expected sales. In this example that's on the screen, this company has a 20% margin of safety. That means that the company could lose 20% of its sales and still not suffer a loss. Take a look at that, and then let's apply it on this last exercise. To finish this problem off, the author asks us for the margin of safety as a percentage. So let's go ahead and write down the formula. I would encourage you guys to write down the formula every single time when you're trying your homework. Don't get so used to going into Connect and just decide that you're going to click drop-down boxes. If you do that, you're shortcutting the learning process. So how far above the break-even point are we? We said the desired profit, target sales to achieve that desired profit was $2,430,000. We know that the break-even sales that we calculated previously is $1,620,000. To turn the $810,000 cushion in sales dollars into a percentage, we will divide the $810,000 by the actual expected sales. When we do that, we will get a margin of safety, let me turn that into a percentage, of about 33.33%. That means that this company could suffer a 1/3 drop in sales and still not lose money. It's a safety cushion, so when you think of the margin of safety, think of the word cushion, and I think that will help you remember how to compute it. This next exercise is just more of the same, meant to give you extra practice. Pause the video and see if you can calculate the target income in units and dollars. Another suggestion while you're doing your homework, write down the facts of the problem. That will help you in more complicated chapters to narrow your focus on the relevant information. So in this case, we were given the set of facts that the selling price was $180, the variable cost was $135, and immediately the first thing I calculated is the contribution margin. I probably should have taken that a step further and also should have computed the contribution margin ratio. In fact, let me do it right now as we speak. So we know that per unit, $45 of every sale is available to cover fixed cost and generate a profit. expressed as a percentage, that contribution margin ratio is 25%. They asked us how many units, okay, notice the emphasis on units in number 1, how many units do they need to sell to reach their target profit? So here's the formula. That would be the first thing I should see written on your paper. Fixed costs plus the target profit divided by the unit contribution margin. The reason we use the unit contribution margin is because the author specifically asked for units. Number 2 wanted you to convert the units into sales dollars. You can do that one of 2 ways. I took a shortcut by taking the 35,000 units multiplied by the sales price of 180. When I did that, I got an answer of 6.3 million. Or you can convert the formula to dollars by dividing by the contribution margin ratio, that 25% that we just computed. Either way, you'll get the same answer. By now, you should be starting to feel comfortable with the target profit approach. Let's wrap this up by taking a look at other ways that cost volume profit can be looked at. One of the beautiful things about cost volume profit is that we can easily adapt our formula to handle changes in estimates. I know I've been in business strategy meetings where as soon as you answer the question, what is our break-even point or what is our target profit point, somebody at the table brings up a what-if scenario. What if our sales price were bumped up by $4? What if we decide to run a special promotion and temporarily reduce our sales dollars? What happens if our insurance costs go up? And the questions are endless. So we can use cost volume profit to analyze the effects of alternative business strategies. Sometimes we do it on break even, sometimes we look at the bottom line, and sometimes we're just looking for safety net purposes. How much can we increase in sales? And sometimes, especially during these turbulent times, how much can our sales drop and still not affect us in the short term? Other investment decisions: should we spend money to automate? Should we increase our fixed costs if we can decrease our human labor costs? Or should we run a special advertising campaign? Most of these questions can be answered with cost volume profit. So to end our session today, let's take a look at a brief what if question. And then our second day of cost volume profit in another video will be geared more towards these scenarios. I want to remind you that you cannot practice enough. So let's try our last problem for the day. You'll notice that the details of this problem look similar to other ones that we've worked out today. This time, they're going to increase the sales to 40,000 units, and the price will be $200 per unit. They give you a prediction on the variable costs and let you know that fixed costs will remain fixed. Their question is, how much income can the company expect to earn under these predicted changes? And they gave you a hint. They would like you to prepare a contribution margin income statement. So let's see if you can come up with the correct answer for this one, and we'll call it a day. Take a moment to review the data. Notice that at the upper right, I wrote down the facts as I read them so I could focus my attention on whatever question the author wants to throw at me. So here's the contribution margin income statement. We took the sales, 40,000 units at 200. That was the new selling price. We computed the variable costs at 140 using the data they gave us. Once we extended that out, we came up with the contribution margin. We took out the fixed costs, which remained the same, and we wound up with the net income as you see on the screen. How'd you do? For an extra measure of practice, you may want to even calculate the margin of safety, both in dollars and as a percentage, and compare it to the exercise that looked very similar to this one. Let's practice, 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 and we'll give your brains a rest before we attack the second half of the chapter.
So we're going to jump in, and for starters, we're going to do exercise 18-8. And I think once we get some numbers up there, we can talk more about what's this information going to help us. How is this information going to help us make some decisions? So questions before we go any further. And is Eddie in here? I can't see him. No, he might have gotten booted out. Hopefully he'll come back. Okay, a jeans maker is designing a new line of jeans called Slims. The jeans will sell for $205 per pair. Wow, that's a big selling price.
It slims out your wallet.
Yeah, it does. And costs $164 per pair in variable cost to make. Okay, let's take a look at the contribution margin. Since they only gave us per unit numbers, that's what we're going to focus on in this problem. So here's what we know. The selling price less the variable costs gives us the contribution margin. So the sales price of $205 less the variable cost of $164 are going to give us this contribution margin, once I put that in there, of $41 per unit. Okay, what the heck does that mean? Let me make this bigger. That means that there is $41 to cover the fixed cost and generate a profit. So that is the contribution margin on a per unit level, because they told us how much we would sell one pair of jeans for. And they told us how much the variable costs, both production and selling, all the variable costs totaled $164. So we're making $41 per unit. That's going to have to cover the fixed costs and generate a profit. Okay, now they didn't tell us how many jeans we were going to sell, so I can't tell you what it is in total dollars, but I can tell you what it is as a percentage. So this contribution margin ratio is going to become very important. I'm going to write down what that means. This is what number 2 wants. The contribution margin ratio is equal to the contribution margin divided by the selling price. Okay, so let's do that real quick, and then I'll tell you what else we can learn from that. The contribution margin is 41. We just calculated that. In fact, let me put some color so you can see where that came from. The contribution margin was 41. The selling price was 205. And when I pop that into my calculator, you guys can do it with me, I get 20%. If I format that as a percentage, it'll become even a little bit more clear. Okay, well, that means that for every pair of jeans I sell, 20% of the sales price is available to cover the fixed costs and to generate a profit. Let me tell you what else that tells you. And it's not very clear in the book. Again, I'm going to move this over a little bit so I can show you something. And make my columns a little bigger. The other thing that tells us is if this is 20%, we just computed it to be 20%, and sales is always 100%, then right off the bat, without them saying anything further, we know that the variable costs are 80%. So I can tell a lot when I know the contribution margin. Okay, number 3 says describe what the contribution margin reveals. I think we just said what it reveals. 20% of every jean sale is available to cover fixed costs and to generate a profit. Let me see if the author will give us a better or a different explanation. Copy this. I think he said the same thing I did, but I'm going to copy his answer down here. The contribution margin of 20% implies that for every dollar in sales, the company has 20 cents that contributes to fixed costs and profit. Once they get their fixed costs covered, 20 cents is going to go right down to the bottom line. We'll see that happen. They're going to, in our next set of exercises, they're going to ask us a bunch of what if questions.
So this 20 cents you mentioned, or the 20%, you said it says it covers fixed cost and generate a profit. So I still, from this $41, I don't know what fixed cost still is, because what if it's $40? Then $1 is only profit because the word "and." So
Yeah.
this 41 still mixed with a fixed cost and profit. That doesn't necessarily mean I made it profit, because I could have fixed cost at 41.
Yep.
How I'm seeing it.
You're seeing it perfectly. So
Oh,
they just didn't give us enough information yet to see what's going to happen once the fixed costs are covered. But you're exactly right. They didn't mention fixed costs on this one. They will bring that into the rest of the problems that we do, Danya. And
okay.
once you're going to see, once they are profitable on that bottom line, or they're even at break even, once they hit their break even point, everything above the break even point is going to bring in profit, and everything below the break even point is going to result in a loss. So we haven't quite got there yet, but we will be bringing that into the mix.
Okay.
Good questions you're thinking. And can you guys tell me, is Eddie in the room? I can't see him.
He's kind of went away there. It's been
Okay.
about 20 minutes. Yeah.
Okay. If you guys happen to see things in the chat room that I can't see, please pass those along, because I lose it. Okay. That was the only reason I was concerned is I didn't want to miss anything in the chat room. Okay, Danya, I think this one's going to bring it home. I think this one might start to bring the concept home. So Blanchard Company, and by the way, this same set of facts is going to be used in like the next 4 exercises. So we're going to be doing a lot of what ifs. And I think, Danya, that the light's going to go on, which happens when we start practicing. So it says Blanchard Company manufactures a single product that sells for $180 per unit. Okay, I better write that down as we go. The selling price is $180, and they're giving this to us on a per unit basis. I'm going to write that down. And whose total variable costs are $135. And Neff, I think you might be, you might want to mute yourself, because I think we hear background noise. It's because you helped me answer that question. Thank you. Okay, so I've read just the first sentence so far. So before I go any further, I'm going to automatically compute this contribution margin. I got $45 per unit. And also, before I go any further, just based on what the author has given me so far, and he hasn't given me a whole lot, but I know how this works. I know that if I calculate that contribution margin on a percentage basis, your book calls this the contribution margin ratio, we can tell a whole lot about their cost structure. So the contribution margin ratio is the contribution margin divided by the sales. So on a per unit basis, if my contribution margin is 45 and my selling price is 180, let's go compute that real quick. 45 divided by 180. I'm going to format this as a percentage. If I know that my contribution margin is 25%, you know what your variable costs are automatically. Okay, because sales is always 100%. And if my contribution margin is 25%, that means, even though they didn't give this to us, that means that my variable costs are 75%. So I haven't even finished reading the question yet. I'm just looking at this cost structure of this company that sells a single product. So questions on that so far? Okay, then let's keep going. it says the company's fixed costs. So Danya, this is the first time that they've brought fixed costs into this mix. It says use this information to compute the company's A contribution margin. Okay, done. We did that right here. The contribution margin is $45 per unit. Make it red so it stands out. The company's B contribution margin ratio. Okay, we did that already because we're going to get in the habit of doing that even if they don't ask. And C, the break-even point. Okay, this is the new part. This is one of the applications of the contribution margin. So let me get that into your notes. One of the applications for the contribution margin is the break-even point. And you may have learned in your econ classes that the break-even point is where there's no profit and no loss. It's the point of activity where the revenues equal the expenses. And so here's a formula for break-even point, and I would encourage you to memorize. I'm not real big into rote memorization, but I think this one, it's a lot easier to memorize this one formula, which we'll do spin-offs from it, than it is to try and understand mathematically how to calculate the break-even point or graphically. So here's what we know. The break-even point is fixed costs divided by the unit contribution margin. And you could prove this mathematically. I'll let the author's example stand as a proof to you. But for this application, they told us what our fixed costs were. I circled them up there, $562,500 divided by the contribution margin of $45 per unit. Let's calculate the break-even point in units. Okay, so I'm going to do that. 562,500 divided by 45. I need to sell 12,500 units to break even. Why is that good to know? Anything above that point, I'm going to have a profit. Anything below that point, I'm going to have a loss. So they wanted the break-even point in units. Okay, that's what we just computed. That's letter C. And they also wanted it in dollars. So I'm going to take a shortcut first. I'm going to show you how I would calculate this in dollars. And then I'll show you a second formula that will always work to compute dollars. So if I wanted to turn these units here, let me put them in yellow. If I wanted to turn those units into sales dollars, all I'd have to do is take those 12,500 units and multiply by the selling price. And that would be one way to do it. So let's answer that. 12,500 times 180. There's my break-even point in dollars. Anything above that would result in a profit. Anything below that in sales dollars would result in a loss. All business plans ask you for that point. An alternative, and here's where another formula is going to come in. So I'm going to put or to calculate break-even points in dollars. You can go directly to a formula to calculate the break-even point in dollars. We already know what it is because we took a shortcut. But the other way we could do that is we could put fixed costs on the top and the contribution margin ratio on the bottom. Let's try it. Let's see if we get the same thing. So the fixed cost, we know. Let me go grab that. The contribution margin, we know because we did it at the very start, knowing how it's going to change the way we do lots of calculations. It was 25%. When you pop that into your calculator, you're going to get the same answer here. We just went a different way about getting it. So it's no surprise that we got exactly the same number. the break-even point is the point at which no profit is made, no loss is generated, because our fixed costs are covered now. Any additional unit, anything above 12,500 units, the contribution margin is going to go right to the bottom line because the fixed costs are now covered. And that's what was missing in the last problem, Danya, I think, why you were having some trouble understanding it.
Can you go back at the 25, the CM ratio?
Uh-huh. Yep. How did I get that?
Yeah, like what is it that you're dividing it by?
Okay, so here it is, the formula, and we'll walk through it. We're taking the $45 contribution margin per unit, and we divided by the sales price. So the formula is right here, 45 divided by 180 gave me that 25%.
Okay, so then you're back to the calculating the BE point in dollars versus CM ratio. So we're trying to do the math. So it's 0.25 that we're dividing that 562,500.
Yes, unless you have a percentage key on your calculator, then you can just type in 25%, but 0.25 is equivalent decimal wise.
Okay, so that's what we were doing.
Did you get 2,250,000?
Yeah, I just got that because first I'm like, wait, am I plugging in the 45 or the actual 0.25?
So that's a good question.
50%.
In the first one, when we were calculating the break-even point per unit, we plugged in the per unit value, $45. When we were calculating the second one, the break-even point in dollars, that's where we were plugging in that percentage, that ratio.
Okay, and this is the dollar. So on the breaking even point, which was 562,500 divided for 45 per unit. These two were dollars in the beginning, and we got units.
So to get the per unit, how many actual units of coffee cups, however many units of coffee cups we needed to sell to break even, we computed that by taking the fixed cost divided by the per unit contribution margin. That's units. And then we turned it into dollars. I took the shortcut by multiplying it by the selling price of 1. Okay, that's how we did it the first way. The second way, it's an alternative. That's why this or is here. The second way that we could calculate it by sales dollars is by taking the fixed costs, which are dollars. Let me put a dollar sign on that. And divide by the contribution margin ratio, divide by that 25%. And we got exactly the same answer as we got doing our shortcut. So Danya, I think I'm going to prove this to you. I'm going to go back and do an income statement because I want to prove it to you.
Well, I was looking at the dollar divided by dollar gave me units because I was putting the answer as in dollar. So that's where I was like, wait a minute, why are we doing it? Because we already had the dollar. But no, you're talking about units, numbers versus dollar.
Units and dollars.
Okay.
You always want units first, dollars always, if you can, if they give you enough data to do it. But I am going to prove this to you because here's what our income statements are going to look like from here on out. It's going to say sales, and the book did not ask you on this problem to do it. They might have asked us on another one. We're going to take sales minus variable costs. That's going to give us our contribution margin. We're going to take out fixed costs, and that's going to give us net income. Let me put some total lines in here to show you what we're going to compute. And I think I'll go fix my spelling error in a second. All right, if my sales are 2,250,000, right? Remember what that is? That is the break-even point. So if I asked you, can you create an income statement now, not using the traditional method, but using this forecasting model or this managerial concept, I guess you would call it. I know based on up here, based on what we did up here, that 75% of my sales are variable costs. And I got dollars sorry, total lines in the wrong places. Let me go clear those. And let me put my total lines back in here where they should be. I'll start over. I'm going to prove to you that based on this cost concept, our net income will be zero because 75% of our costs are variable. So I'm going to multiply that out. My contribution margin then would be the difference. And of course, my dollars, since I wiped out my formats, it also wiped out my font sizes. And I know what my fixed costs are because they told me. I just proved that my break-even calculation is right. At that level of sales, we did wind up making zero net income. So we calculated our break-even point. We did it two ways. We did it in units. That's needed by the production side. How many units do we at a minimum need to produce? We also did it in dollars. That's needed by the accounting side. And our shareholders don't really care about units. Our shareholders want to see dollars. So that is a contribution margin income statement. So what our income statements are going to be looking like from here on out. Danya, go ahead. Did you have a question?
No, sorry.
Okay. That's a lot of stuff. So if you do have a question, please ask, because we're going to keep building upon this. In fact, the next 3 exercises that we do are all going to come back to the same data that we've just used. So we may be copying data over. Okay, let's keep going then. Blanchard Company, is that the same? Let's go see. 180. Yeah, same Blanchard Company. So the exact same set of data. I think what I'm going to do is copy this per unit data over, just so we don't have to keep doing it, repeating it again. You guys may want to do the same thing. So you can go up here and copy and paste. It's the same company, so I'm just going to bring the data over. You may want to do the same thing. If not, you can just compute it really quickly. So Blanchard Company, the same company that we just talked about, manufactures a single product line that sells for 180, variable costs are 135, fixed costs are 562. Oh, we just did what they asked us. Prepare a contribution margin income statement showing sales, variable costs, and fixed costs at the break-even point. Okay, we just did that. Let's see if I can carry that over. Got ahead of ourselves. Was trying to prove something. Let me see if I can bring that over. If not, you can just put see previous page, or we'll fill it in here again. Okay. Didn't like copying it over, so 2,250,000. I'm going to put see previous exercise. There we go. So they asked us to do an income statement. We just did that. Now, here's a what if question. This will be our first what if. Number 2 says, if the company's fixed costs go up, what amount of sales, Danya, back to your question, in dollars, not units. Sometimes he's going to ask us units. Sometimes he's going to ask us dollars. What amount of sales in dollars is needed to break even? Okay, stop. We need to start critically thinking with our brains on what's going to happen to the break-even point. What do you think? If our costs go up, what's going to happen to our break-even point?
We're going to be under?
Well, it has to go up. Why? Because if our costs go up, we need to sell more units to make up for that added costs. So we're going to do another break-even problem here. and I'm going to write out the formula. And if you see me write out the formula 10 times, that's okay. We're going to do it till it sticks. So here's what they're asking us. If fixed costs go up, what is going to happen to the break-even point? And I'm going to tell you, if our costs go up, we know by using our critical thinking skill that our break-even point will go up. By how much? We're going to figure it out. We're going to go back to that break-even point. And here's what our formula says. The break-even point, and since they asked specifically in dollars, let's use that formula that will give us that answer. And that formula is fixed costs divided by the contribution margin ratio. Okay, an example of this, and then we'll do it. An example would be, maybe you guys are getting the same thing. I just got a big increase in some insurance costs for me, for my business. Well, and for me personally, right? I'm going to have to sell more units to break even because I'm going to have to cover those increased fixed costs. Typically, insurance is a fixed cost. So how much more will our old fixed costs were $562,500. Okay, I'm going to put in here $562,500. That's my old break even. Sorry, my old fixed costs. What they just told me in that problem is your fixed costs are going to go up by $135,000. So now here's my new fixed costs. I'll write down how I got that in case that went too fast for any of you. That was my old fixed costs. Let me write that down. Old fixed costs plus the new fixed costs. And I'll go fix my spelling error. Now I'm going to put in my contribution margin ratio. Why am I using the ratio instead of units? Because they asked me for my break-even point in dollars. So because they asked me in dollars, I'm going to use that contribution margin percentage. I'm going to put in 25%. And here's what my new break-even point will be once you guys put that in your calculator. 2,790,000 is the new break-even point. So in order for that company to stay at a break-even point, they have to sell, and you can compare that to the previous example, they have to sell that much more in order to cover those new fixed costs. So I'm going to write that down. The company will need to sell, and I'm going to calculate the difference right here between the old one and the new one. More in sales to cover those newly added fixed costs. How did I get that? The difference between the old break-even sales and the new break-even sales. There's lots of what if questions that can come up.
If I were to grab that same dollar, instead of dividing it by 0.25 and divide it by the $45 per unit, now I can grab the number of units that I have to.
Yes, ma'am.
To cover.
Yep. So let's do that, Danya. How many more units will they have to sell to break even? There's lots of ways you could answer this, by the way, but I'm going to do what Danya just suggested. I'm going to take those new fixed costs on the top, and I'm going to divide by the number of units, the contribution margin per unit. And I forgot what it was. It was $45. That's what she just asked. So here is the new fixed cost divided by the contribution margin per unit. She wanted to know how many units would that be. There's lots of ways to answer that, but here's one. That's the new break-even point in units. So if you look at the old units and the new units, that's how many more units you would have to sell. I think the old one, if we went back, was 12,500. So another way of looking at that, you would have to sell 3,000 more units to cover the new fixed costs. So lots of information going on. And also lots of alternative ways to solve these as well. Let me stop. There's probably a lot of questions spinning around in those heads. Ask away. We're not done with it. We're going to keep going, but any questions so far? Okay. Eddie texted me that he had to leave for something. So if you guys see chat room things, please pass them along. Okay, let's keep looking, because most people, most companies are not interested in simply breaking even. They need to feed the family. They need to go home and take money out of their company to do that. So let's keep reading. It says Blanchard Company, that same company that we've been dealing with, sells a product for 180, variable costs are 135, nothing's changed. Fixed costs haven't changed. Here's the difference. They target a pre-tax income. In other words, they don't want to just break even. They want to generate profit. Assume that fixed costs remain at 562,500. They want unit sales and dollar sales, not to break even, but to hit that target profit. Okay, so exercise 1812 is a target profit problem. Okay, well, basically what we're going to do is we're going to tweak the break even problem. So I'm going to go back to break even, but I'm going to turn it into a target profit problem, and I'll show you how. Instead of having just fixed costs on the top now, we don't want just fixed costs. We want enough to cover fixed costs and to generate a profit. And the bottom stays the same. Since they asked us first for units, we're going to divide by the unit contribution margin. And once we know that, we'll turn it into sales dollars. Okay, so stop. We're introducing a new concept. We're introducing a spinoff of the break-even point. And the spinoff is the top isn't just going to be enough to cover the fixed costs, and the bottom is the contribution margin. We want profit up there now. So we're tweaking the break-even formula to cover profit on the top. So let's calculate that. The fixed costs are the 562,500. They didn't change. And the profit, I'm going to put in there from the problem, 1,102,500. So let me put for your notes what that is. It is the fixed costs plus the profit. That's what goes on the top. What goes on the bottom is that same old unit per unit contribution margin, 45. Pop that into your calculator. And this is how many units we need to sell to generate that target profit. So this is 18-12. It is a tweaked break-even application. We don't want to break even anymore. The new part here is the profit component. So we added it to the top, or the numerator. We need to sell 35,000 units to generate that 1,012,500 in profit. So that's the answer to number one, requirement one. I'll put that in red so it stands out. And what goes right behind that, requirement 2 says, well, what about sales dollars? Okay, so there's two ways. There's the easy, what I call quick and dirty way, which is typically what I tend to do, or we could use that other formula. So I'm going to call this quick and dirty for me is just take that 35,000 units that we just calculated and multiply it by the sales price for 1 unit. And that sale price was 180. And that'll easily give me the sales dollars. I'll put a $sign on that so we know that that's sales dollars. Okay, or remember, there's lots of alternatives. I can go back to the target profit formula for dollars. And what I would do in that case, my numerator would be exactly the same, but instead of dividing by $45, I would divide by the contribution margin ratios. Okay, so the top's the same. I'm going to go grab the top. That did not change. The bottom is what's changing. So let's go divide by the contribution margin ratio. I think it was 25, but let me go check. Yes. Sorry, the gardeners are here. You guys always have to deal with that. And pop that in. And we got exactly the same number, however you choose to do it. So what does that mean? We need to sell 6,300,000 in sales in order to generate that profit that they gave us. It's a lot to absorb. It's a lot of calculations. Please ask questions while I go fill in or fix spelling issues. So now the what if scenarios are probably going to begin. Another thing I wanted to point out to you. Now that our fixed costs are covered, okay, because I brought that wording up and we were a little confused on what that meant. Now that our fixed costs are covered, okay, and you might be saying, how do you know your fixed costs are covered? We're generating a profit. I know our fixed costs are covered. If we're generating a profit, our fixed costs are covered. For each additional unit that we sell, $45 is going right to the bottom line. So if you're wondering, sometimes McDonald's is across the street on the other side of Edinger from my house. If you're wondering, how does McDonald's make money by, selling you Big Macs for $1 sometimes? It's because they've reached a point where they're selling so much that it's almost pure profit. Not only that, they sell you a $2 drink. I haven't eaten at McDonald's in years. I have no idea what their drinks sell for, but they sell you a $2 or $3 drink that costs them 2.5 cents. So they offer these special products because once they hit a certain level, it's all going to the bottom line. Questions? Okay, then the last part, I was going to do this anyway, so glad they brought it up. Says Blanchard Company, same exact problem here. The sales manager predicts the annual sales of the company's product will soon reach 40,000 units. Okay, remember how many units they were selling over here? 35. So they're selling now 40,000 units, and its price will increase to 200. According to the production manager, variable costs are expected to increase to $140 a unit, but fixed costs will remain fixed. Okay, so they've had some changes. Their selling price is going up. Okay, that means that if all else was the same, we'd have to sell less units if our selling price is going up. But variable costs are also going up. Okay, an increase in cost means we'll have to sell more units. I'm just trying to get you to think about this cognitively. We're going to do it mathematically. Fixed costs will remain constant. They give us a tax rate. What amounts of pre-tax, that means before tax, and after-tax income can the company expect to earn from these predicted changes? Okay, hint, prepare a forecasted contribution margin income statement. Okay, well, here's what I'm going to do. I'm going to go back to what I know. I know that the contribution margin is the difference between the selling price and the variable costs. So before I even read that question for a second time, I know two things were changing. They said the fixed costs remain fixed, which often happens, but they had a change. And the change was the selling price goes up to 200 and the variable costs are going to go up to 140. Let's put that in. The selling price is 200. The variable costs are 140. So my contribution margin now is $60. Let me stop. Any questions on the 60? Before I go any further, I'm going to also calculate that contribution margin as a percentage. Your book calls that the contribution margin ratio. And again, Danya asked some great questions. We reviewed how we calculated that. It's the contribution margin divided by the sales price. So here's what I'm going to do. I'm going to take that contribution margin and I'm going to divide by the sales price, and that's going to give me a percentage of 30%. So what can I tell from that 30%? If my sales price is always 100%, I can tell you indirectly that your variable costs are 70%. That's going to help me do this forecasted income statement. So let me stop for a second. See if you guys have any questions. And what I'm going to do is that new forecasted income statement. How am I going to do it? I'm going to change the way we're thinking from here on out about financial statements. I'm not going to set up a traditional one. I'm going to set up a managerial income statement. It's going to look like this. We're going to have sales, and then we're going to take out the variable costs. And that's going to give us this all important contribution margin that I want us to get in the habit of computing 3 ways, which I will do on this problem. We've done 2 out of the 3 so far. I'll take out my fixed costs, and that will give me net income before tax, what your book calls pre-tax. And let me put some total lines in here so you'll understand what it is that we're calculating. Then he gave me an income tax rate at 20%. And so this will give us net income post or after tax. So if you're wondering, how do companies project out their earnings? They're always doing earnings forecasts, and they publish those a lot. And the stock market automatically reacts. They're doing projections. This is a projection on a much simpler scale. So the sales, remember, was based on 40,000 units. So I'm going to put that up here. This is all based on the 40,000 units that they mentioned they are predicting. So if they're selling 40,000 units at $200 per unit, that's enough to get us that's pretty much enough to give us the rest of this. How can I say that? Because we know the cost breakdown right here. We looked at it. So 40,000 units at 200, go ahead and compute that. I got 8 million. If I know that based on what we computed earlier, that my variable costs are 75%, sorry, not on this one, 70, my bad. And my contribution margin's 30%, we can automatically calculate that. 8 million times 70%, there's their variable costs. And the 30% can either be computed, or you can take the difference between these two. Either way, you're going to get the same answer. Let's drop in the fixed costs. Remember, those were not changing. I'm going to write in, did not change. So they got a new prediction now. Here's going to be their net income before tax. How'd I get that? That's the contribution margin less the fixed costs. And if I'm getting taxed at the rate of 20%, we'll take that amount right above it times 20%, 0.20 if you don't have a percentage key, 20% if you do. There's the tax I need to pay over to the government. And the net income would be the difference. There's their forecasted pre and post-tax income statement. There's so many what ifs that I wish they would have brought into this problem. Here's what I mean by what if. I'm going to make some up since the author didn't bring too many in. First question, are our fixed costs covered? The answer is yes. How do I know this? Because this bottom line is more than zero. Our fixed costs are covered. So here's what I want you and eventually to be able to do in your head. What if a manager comes in and says, you know what, I think we can sell 2,000 more units. I'm just pulling these numbers out of the air. If we could sell 2,000 more units, what would happen to the bottom line? Okay, I don't have to do an income statement on this. I've learned enough by working through so many of these problems and understanding all these what if scenarios. I can tell you what's going to happen to the bottom line without doing an income statement because my fixed costs are covered. $60 from every unit is now going to go right to the bottom line. So what's my net income going to be? 2,000 more units times $60 per unit, and contribution margin will go right to the bottom line. So without doing an income statement, just on my calculator, 2,000 times 60, my net income will increase by 120,000. Okay, how do I know that? 2,000 more units times $60 per unit now is going to go right to the bottom line because the fixed costs are covered. My net income will increase by 120,000. So if somebody wanted to know, well, how much net income is that? Here's my old net income plus that 120,000 increase. There's my new net income without doing an income statement. Now that would work pre-tax, actually. That would be better used on the pre-tax line. I'm just giving you some information on, let's forget about taxes. 120,000 would go pre-tax right to my bottom line. What if they said, because this comes up too, we could sell 2,000 more units, but it would cost us in advertising. In other words, we're going to print some coupons. It's going to cost us in advertising. And what if they say the advertising is going to cost 30,000? Well, 120,000 would be coming in, less 30,000 that you spend in more advertising. You still have a positive bottom line effect of 90,000 in this made up example. There's lots of what if questions that can be answered. And when you're sitting in a management position, you can't just say, oh, let me go back to my office and create a new income statement. You need to be able to answer whenever possible off the cuff. And these are the techniques that we use to do that. Questions on that? Very powerful tools once you understand and you practice the concept of this contribution margin. Let's see if they, okay, here we go. Same problem. Let's keep going on this one. Same problem. It says, oh, maybe it changed it. Bloom Company. I saw the BL and thought, oh, same company, different company. Bloom Company predicts that it will incur fixed costs, when I read these, I kind of circle the components so I don't have to read so many times. So my fixed costs are 160. My pre-tax income's 164 in the next period. Their contribution margin ratio is 25%. They want the amount of total dollar sales and total variable costs. Okay, I think we can do this. Here's what I know. I'm going to go with what I know. I know that sales less my variable costs give me this contribution margin. And I know that sales is always 100%. And they told me that their contribution margin is 25%. Okay, that means indirectly they said it, this is 75%. We can tell that. Now, if we keep going down to the bottom line, if we take out fixed costs, we have net income. So use this formula to compute the total amount of dollar sales and total variable costs. Okay, here's what I know. I know that they wanted to make 164,000. So I'm going to go back to this tweaked break-even formula, but it's tweaked to be profit. Fixed costs plus profit divided by, and since we're doing dollars on here, I'm going to go ahead and use the contribution margin ratio on the bottom. Wouldn't really do me too much good to do units right now because they didn't give me a whole lot of information. So I'm going to use the formula that's going to give me dollars. Okay, pop this into your calculator, 160,000 plus the profit. So that goes on the top, and I'll write that down in case you missed it for your notes. I'm also remembering I'm taking notes for Eddie now. That's how we got the top. And the contribution margin is 25%. That was given. So my sales needed to generate the profit. We're going to do that math. You guys double check me because Eddie's not here. The sales needed to generate that level of specified profit is 1,296,000. And now they want an actual income statement. So that's easy enough to do. Questions on where that red number came from? Okay, let's follow that up then with this income statement. I'm going to go grab my sales from that number. And now I'm just going to use the percentages that I know to be true. The variable costs are 75% of that. The contribution margin is 25% of that, or you can just take the difference. It'll come out mathematically to be the same. The fixed costs were 160,000. It should be no surprise that when I calculate my net income, we just proved that that number is correct because they did generate that 164,000. And remember, this was pre-tax. They didn't give us a tax percentage. Once you know your cost structure, you can answer so many different what if scenarios. Questions? Okay, I'm going to give you a scenario then, because they didn't do a very good job of giving you too much to work with here. If you could increase sales by 100,000, what would your net income be? I don't want you doing a whole nother income statement. Anyone can do that, right? I want you to look at the tools you're given. here's what you ask yourself. Are our fixed costs covered? Answer, yes. Well, how do I know that? We've made a profit. It's above zero. If it's above zero, for every sales dollar you make, 25% of it is going straight to the bottom line because the fixed costs are already covered. So 25% of that, or $25,000, would be the increased net income. So if you know that your old net income is 164,000 and you're going to add 25,000 to that, how do I get 25,000? The contribution margin's 25%. There's 100,000 units, 100,000 times 25%. You're going to be adding 25,000 to the bottom line without doing a brand new income statement, just in your head almost. 164,000. You could add those up with a calculator easily. There's your new net income. You could prove it to yourself. You could go back and do it. But that's what this whole cost, volume, profit analysis is about. If I could buy a new machine and the machine's going to add this much to my fixed costs, should I do it? Well, you calculate what effect is that going to have on the bottom line by looking at how the cost structure is set up. We got one last one to do. I know your brains have been taxed, but it's a really, really, really important chapter because it's going to affect all the predicting and forecasting that we're going to be doing from here on out. Okay, if I don't hear any questions, let's take a look at this last one. I think you guys can easily do this now that we've had extra practice with the others. It says, the following costs result from the production and sale of 12,000 CD sets manufactured by Gilmore Company for the year ended 2019. They sell for 18 bucks. They have a 25% income tax rate. Here's what they want you to do. Before, if we were given this problem, we'd be doing this traditional income statement. Now they want us to set up the statement differently. They want a contribution margin income statement. So what are they looking for? Here's what they're looking for. I'm going to call this a contribution, or what is the term? Man, I don't want to use the term. I don't think they use it. We'll call it managerial is what the word I was trying to come up with, or managerial income statement. Leave yourself space. This is what it's going to look like. We're going to have sales and we're going to take out the variable costs. I'm going to leave myself a lot of space because it looks like I have about 10 or so cost items here. I haven't looked at the cost structure, but I know there's going to be variable costs. I'm going to leave myself a lot of space. Eventually we'll get down to a contribution margin and we'll list fixed costs. And eventually we'll get down to net income. So they asked for a contribution margin income statement. I know that we're changing the way our income statement looks because it's going to help us do a bunch of forecasts. So now I'm going to go through these various items and we're going to put these costs either variable or fixed. Or if they gave us some dangerous mixed costs, they're going to have to give us some more information to solve for that. Let me get the sales line in because they told us how many they were selling, 12,000 CDs, and they told us that the sales price was 18. So let me go and fill that line in, and that'll also help me remember that this is for 12,000 CDs at a selling price of 18. I'll let you guys do the math, especially with Eddie not here. Please feel free to correct me. I never have a problem with being corrected. And I think it would also be a good idea on the way they set up this homework problem to get a per unit item in there. We know that the sales price was $18. Now I'm just going to go through this green box here and we'll take a look at how the costs behave, and they'll either go at the top under variable costs or toward the bottom with the fixed costs. I'm looking at my green data now. Plastic, okay, that's a direct, we know that's direct materials, that's always direct. So under variable is gonna go plastic. Plastic for CDs, and that's 1,500. I'll do the per units all at once. I'll do one formula and keep going. So we'll leave this per unit blank. We'll go back and fill that in. And the wages for the assembly workers, well, that's direct labor. By definition, direct labor is a direct cost or a variable cost. So I'll leave that in the variable section. That was 30,000. The labeling, well, that would definitely be a variable cost because labels go on all the products. So that would be 3,000. So I'm done with these first three. Let me check those off. The variable selling expenses, commissions are always based on sales. So that'll be in the variable costs. Hope that gardener stops before I get mad and yell out the window. I'd yell something nice, but I'd still yell. Okay, fixed manufacturing costs. By definition, these are fixed. That means they don't change over the relevant range. So I'm going to come down here and we don't have to worry about per unit. They're fixed. So the rent is $67.50. The factory cleaning service, they've called it a fixed cost. Doesn't matter how many units they produce, their cleaning crew comes in and they clean up for a fixed rate. And they also have machinery depreciation. If it's straight line, that's also fixed. And so I've taken care of these next three. We got three left. They are all fixed, so they're going to go down here, and I need to create a little bit more space for myself. So let me insert some lines. We have the lease of the office equipment. Remember, it doesn't matter on a managerial statement whether it's factory or selling and administrative. We're doing this now by cost behavior. And we have the system staff salaries. Almost all salaries are fixed. And the admin management salaries, that's fixed. So I got all this data. I'm going to give you guys a chance to catch up. I got all this data down here. And we're going to go focus on calculating a contribution margin income statement. And if they don't ask you any what ifs, we'll talk about some what ifs that we could answer. Okay, I think we got all the data we need. So let me add up my variable costs. And I'll add color to help you see them. And if your author wants per unit costs, and I can tell you that they do, okay, I've seen your homework. If they want per unit costs, then remember how many units this was for, 12,000. So I'm going to make this first formula and I'll let Excel do the rest for me. If you take that variable cost and you divide by 12,000, then we should be able to just copy that formula down. So what did I do? I took this 1,500, which is sitting in V7 on my screen, and I divided by 12,000 units. If I take that and just copy it down, you'll have your per unit costs.
Professor, where did 39,000 come from again, please?
Let's see. I don't think I had 39,000 enough. I took the 1,500 here and I divided by the 12,000 units.
Well, I'm referring to on the line where you have a total variable cost.
Sorry.
39,000.
Yes, it is the sum of these yellow numbers, the total variable cost. It's the 1,500, the 30,000, the 3,000, and the 6,000. And based on that, I probably made a mistake. Did you get something else?
Yeah, that should be 40,500, I think. If you're gonna add up those four.
Okay, thank you for pointing that out. Let me go try it again. 40,500. Is that what you guys got?
Yes.
Correct.
Okay, awesome. So then go ahead and double check. I'm glad you guys saw that, because that would have affected my contribution margin. It would have thrown my problem off. So I'm glad you guys saw that. So this next line item is the most important concept out of this important chapter, I think. And it is called the contribution margin. And we've seen that it's led us to a lot of other formulas today. And I'm going to calculate that contribution margin 3 ways, as many times as I can, on every problem that you come in contact with. I'm going to do it in dollars first. That's the sales less the variable costs. Okay, sales less the variable cost. So I'm going to do it in dollars. I'm going to do it on a per unit basis. Okay, and there might be a little half-cent rounding issue. And then I'm going to go the extra length. I don't know if the problem asks me to do it or not. I'm going to do it on a percentage basis as well. And we call that the contribution margin ratio. And to get that percentage, I'm going to take the contribution margin and I'm going to divide by the sales. So I'm going to put that in there, but then I'll go back and explain to you or write a note on how I came up with that. The way I came up with that for your notes is by taking the contribution margin of 175,500 and dividing by the sales of 216,000. Or you could have done the same thing with the per unit data. You could have taken 1463 divided by 18,000. What the heck does that mean? It means that if I've covered my fixed costs, and we haven't finished this income statement to know if we've covered our fixed costs, but if we have indeed covered our fixed costs, then 81% of every sales dollar is going to go right to the bottom line on anything above the break-even point. Or actually anything, yes, that would be a good way of saying that. Okay, so let's finish off this income statement because we're kind of piecing this together as we go. We have the contribution margin. We have it 3 ways. So someplace in your notes, when you're doing your homework, try to compute that contribution margin all 3 ways. In dollars, we did here. On a per unit basis, that's what we did right here. And as a percentage, that's what we did right here. Now, if you know that sales are 100%, and you know that the contribution margin is 81.3%, you should be able to tell me what the variable percentage is as well. It's going to be the difference, but we'll just go ahead and calculate it since we're working on lots of different things. Let me take the variable costs and divide by the sales, and it's no surprise that that comes out at 18.8. And again, there is a slight rounding issue here. It's just because of rounded numbers. That's what their cost structure looks like right now. Let's go finish this income statement. Let's add up these fixed costs, and I'll make those a different color. And I'm glad you guys are checking me because sometimes I don't quite pick up the right things. Let's sum those yellow numbers up. You guys are definitely going to double check me. I got 167,320 on the fixed costs. We don't have to worry about per unit items because they're not used in our analyses. So this company has been profitable. They have covered all of their fixed costs because their net income is the contribution margin less those fixed costs. Okay, well, that tells me a whole lot. Because the company's profitable, 81.3% of any additional sales are going to go right to the bottom line. So, for example, if I asked you, the question could be asked a bunch of different ways. If they sell, for example, 5,000 more units, could you tell me, without doing a big old income statement, what the net income line would be? Well, here's the contribution margin on a per unit basis. And because I don't want rounding issues to affect us too much, I'm going to take it out one more decimal place. Just increase the decimal there. If I sold 5,000 more units and I know my fixed costs are covered because this number is above zero, then that means I'm going to bring $14 and almost 63 cents directly to the bottom line. So my net income would go up by whatever that turns out to be. And I don't want that a percent. I want that. Let me make sure I calculated that right. 5,000 times $14 and 625. Let me go fix this. About $73,000 more right to the bottom line. So if somebody asked me what's your new net income, you could add these two up and you could answer them. My new net income would be this. That's the power of forecasting. That's the power of having these tools at your fingertips. Questions? I think that covers over half the chapter. We're going to next time talk about complicating factors that come into it. And we're going to look at a company that doesn't just sell one product, not just the jeans, but they sell a variety of products. We call that sales mix strategies. So if you haven't yet read the chapter, do that. This is one of those chapters I want you to read. Unfortunately, I think this weekend, I don't know if it was the rain or just the lazy days that we're feeling, but I would say a quarter of you didn't watch the video. So we gotta step up the speed. We need to keep our foot on that accelerator. Make sure you have the chapter read, and please try and watch the video if you haven't yet done that before our next class. Reach out to your groups if you haven't done that. And I think I've graded 4 or 5 Wall Street journals. You don't want to wait until right before the test to get that done. So let's focus on those things. And unless you guys have any questions, I will see you on Thursdays. Anybody have any questions?
For the project, I uploaded my document, what I thought I wanted to contribute, but if I want to make it shareable where everybody can edit it without having to just save it desktop, re-upload. So how do I get to share it with the rest, and they're actively, it's taking all the edits?
So the way that you would do that is through the use of Google Documents. Let me share my screen. You would have to get permission. The other students would have to accept that you're sharing a little small portion of your Google Drive. So where you would go, I don't know if I can do this on camera. I hope.
Is that the only way though?
Yes, it should. Well, I'm sure it's not the only way, but Google Docs are editable. And so if you go to your tab, if I go to my people tab here and I go to my groups, and let me just go to this first group. If I go visit your home page, you guys all have a little home page. It's over here. Visit home page. Then you have this collaborations over here. It's through the collaborations. If you want to start a new collaboration through the Google Docs, you have to authorize Google Drive access, and then it creates a little document that you guys can upload files back and forth, make edits, and so forth.
Is this how you wanted us to do it, or is there another way of doing it?
The other way to do it, Danya, I'm glad you're asking, is you could send your document to the other 3-4 people, and they could use the track changes feature in Word if you're using Word. Or they could say, here's the following changes that need to be made, and then you control the changes. There's lots of different ways to do that. Right? The reason that I don't personally, this is me personally, has nothing to do with me being a teacher. When I'm a student, me personally, the reason I don't like sharing things in Google Docs is because I feel like I have a pretty good hold on the wording of the project, and then someone can go in and make 20, 30 changes, where I'd rather discuss those first and not just have someone be allowed to go in and make the changes.
Okay.
So if it's the writing part, you can use in Word, you can use the track changes. That way you have the ability to accept or reject the changes that people are making. If it's Excel, you might want to tell your group, hey, here's the Excel, here's the vertical analysis I'm going with. Please double check it and send back your comments to the group or to you on on anything you want changed.
Okay.
Yeah, good question. Anybody else have any questions? Okay, if you guys do come up with questions, I'm always in my office before class. I did have a few people in there today. I'm always available via email, and if we need to Zoom, we can do that too. I think that's it. Then I will see you guys on Wednesday. Read the chapter if you haven't done that yet. Thank you.
Have a good day.
Thank you.
Bye.